Earlier in the year, we were contrarian bullish on China because it seemed like everyone in the world was pessimistic, and we scaled into Chinese equities, particularly in two stages, actually, really, in October last year, and then on the 5th of February.
Was that on valuation?
Yes, it's really valuation driven, but you'd also seen, I think, in our humble opinion, an emotional capitulation, a sort of waterfall price action, particularly in the CSI 300 and 1,000 in early February. So we felt like there was significant capitulation. But what we're seeing more recently, and why we've become pessimistic and scaled back our exposure, is really four things. Number one, the recovery in the credit impulse in China has been very, very weak in the cycle, and that's clearly is related to real estate. Secondly, iron ore has been very, very soft more recently in the iron ore producers. Thirdly, European luxury goods stocks have been performing quite poorly as well over the last couple of months, sort of drawn down quite a lot. LVMH, for example, is an incredibly well-managed business, but is down about 30% from the high, or the last time I looked. And then fourthly, the China 10-year bond yield just trends lower, and that's telling you something, I think, about the recovery as well. So we've become a lot more pessimistic on the cyclical outlook. There will likely be an opportunity again. I think valuation is certainly inexpensive, and where we do have some exposure is still in the China platform names, JD, Baidu, Tencent, for example, Meituan. So we do have some exposure there, but we've trimmed that exposure quite a bit more recently.
Does the setup look a lot more fragile after November the 5th? And I know a lot rests on who occupies the White House. If it is Trump 2.0, then are we going down quite a dangerous rabbit hole in terms of retaliatory tit for tat on the trade front?
It's certainly plausible. I wouldn't necessarily say that a Trump administration would be negative across the board, but it certainly may be even more challenging for China. I think certainly the prospect of much higher tariffs is certainly a negative. I think the other factor which you mentioned earlier is the prospect of cutting back net migration. Again, bringing it back to macro as well, that plus, and especially if a Trump administration also continues irresponsibly loose fiscal policy that's happened under the Biden administration, then that's actually inflationary. So do we actually get a re-acceleration in inflation, a higher cost of capital? In that case, the bond risk premium is not pricing any term premium or any inflation risk compensation or premium as well. So a higher cost of capital will be quite challenging for China and the rest of the world. It probably means in the short term dollar strength. Ironically, the Trump administration probably wouldn't want dollar strength, but that may be the outcome.